difficult part was back, for example, in 2005, when we sold financial stocks at our company, in our management company, we were selling the financials. We were out of them completely from '06, and we still haven't got a buy, by the way. It's difficult for people when things have only gone up to see the wisdom in your ways, to understand that a sell discipline is the only thing we have to stop us from going over the cliff. And you need to have a buy and a sell rule. And everybody buys with hope and optimism and forgets about the sell. So that was the harder part. You know, as I say, a couple of years ago, you know, I'm trying to sort of knock on people's shoulders and say, do you see that, like, that big nasty thing coming towards us? Like, and people are like, oh, you worry too much, you know, the ants and the grasshopper or whatever, you know, fiddling away. And then I think now, unfortunately, great wisdom comes to us through loss typically. That is the nature of human beings. So people that have lost now this cycle are starting to get the aha moment. You know, they're already down in a lot of their equity investments, for example, because we've been in bear market since October of last year. And people are sort of saying, oh, I get it. Oh, it's the cycle thing again. You know, I think the hard part for me was that a lot of those same people were in that cycle in the tech boom. You know, lost a ton. Never mind individuals. How about institutions? How about pension funds? You know, that bought in late and levered up risk and who needs bonds when you can buy, you know, 100% stocks kind of mentality, and then lost heavily in the bear market from 2002, didn't learn the lesson. They, instead of going, okay, so now what we really need to do is save more, increase contributions, and be careful with the capital, they said, oh, you know, where's our next double or nothing? And they started going into commodities with that same desperate, you know, greed-driven thing. And it was like, you know, everyone became sort of the, you know, the harpy people in that Will Smith movie, that was a new Will Smith, and there's these crazy people in it, and they're all running around with white eyes. That's how I felt about, you know, equities and commodities, the risk markets over the last couple of years. So the realization's now hitting, I think, to a lot of people. And as I say, I'm hopeful that they're taking some valuable lessons out of that. And there's no shame in it, because, as I say, every good money manager, for example, that I've ever known in my life who's taught me anything valuable has taught me that it's about honesty, humility about your mistakes, and resolving to learn and change your behavior. That's all we have as humans. We are very susceptible to mistakes, but the strength that we take out of them is what is valuable in the long run. Well, we believe that active risk management requires you to not be long always anything, okay? It means that you must use cash, you know, currencies, bonds, equities, commodity exposure when it's fortuitous at the right time and that sort of thing. But none of those can be just passively held. I write in the book, and I write on the blog a lot about the fact that we changed into a secular shift, a different fundamental climate in 2000 than we were in from 82 to 99. We were in a secular bull climate in equities during the 82 to 99 run. So buy and hold became the rage. People thought, you know, timing didn't matter, just get in because it's going up, that kind of thing. And so they shifted that mentality and continued after the tech wreck. But they didn't appreciate that we entered a secular bear climate in that period, which means completely different approaches needed to get anywhere. Much more tactical strategies required. You know, we had the same climate 66 to 82. During that period, what you had was essentially, okay, a 17-year secular period when markets went in a trading range. Okay, so each business cycle, yes, expansion out of the bottom, but basically peaks and goes back down to support. And the same thing the next business cycle. So rather than doing this and having an upward trend, which would be a secular bull cycle, you had this kind of range-bound thing. You can make money in that, but you need to do a complete mental shift. You can't just sail. You have to row. Right? So that means that you have to have a buy and a sell rule, as I said. We use primarily ETFs for our equity exposure and for commodities because we don't believe in picking individual stocks. It's the realization that nobody consumes like the U.S. and that the rest of the world, if they are to pull themselves out of, you know, dirt huts, need that consumption to pull the cart. So I think what's going to happen is, this is my guess, that we are going to get to a point where U.S. debt is written down. We've done it for emerging economies over the years many times when, you know, they used to owe the U.S. too much money and they couldn't pay it, and it was putting their economies into a depression. You know, you got to admit when you've overlent, frankly. And Asian economies have overlent to the U.S. It's like when Donald Trump calls in the bankers, you know, and in the times he almost went bust, he calls in the bankers. He says, guys, here's the deal. You can put me into bankruptcy if you want, but you need me. That's what the U.S. has to do. In the end, it has to happen on every level. It has to happen on the home front, you know, the securitization of the mortgages. Lots of dumb stuff was done, money that should never have been lent, equity that was never there. It was all vapor equity that's now, you know, obviously not there. Fine, write down the debt. You know, what we did after the Depression when the Home and Loan Savings Company had to write down the debt, say to a person, what mortgage can you afford? Okay, here's what we're going to do. Throw away the bad debt that was a mistake. We'll take responsibility for that, and we'll rewrite debt into things that can keep you in your house. So it has to be an admission of what needs to be done, and it has to be this idea that you can push profits indefinitely and you have to keep having a certain profit growth. We have to get rid of that for a bit. We have to be much more practical. And I think that what will happen is the U.S. will eventually, in all those ways, pragmatic ways, write down debt both on household levels, you know, on government levels, because it's really just paper. If you think about it, it's really just paper. So if you really can't pay them and you really want the person to keep consuming, you're going to have to tear up the paper and start again. And basically, I think that's what's going to happen because, as I say, in terms of the world consumption and the world wealth and the world leading the way, and I also hope that the U.S. does it through green technology, because you want to talk about an area where they have a leg up, they have an opportunity to be incredibly innovative. And they could turn themselves around just on that if they would, you know, get away from the obsession with drill, baby, drill, grow up, and just realize we're in a completely different world, and here's the ticket. You want to build products that the world's going to buy and it's going to pull everything out of the doldrums? Focus on what products are going to actually service the world. Wow. Well, they're going to have to, I mean, I'm not sure of the inner workings of how they'll do it, but I do know that there's no other currency ready to be the benchmark. There is not. And you know what? Neither's gold. I'm sorry, folks, but we can't run the world on gold bars. We just can't. You know, I was telling someone else, I took my kids to the Mint a couple of weeks ago, and there was a gold bar there, $400,000 gold bar. So my kids are looking at it, they go, Mom, so you mean this bar of gold that's this big on the table is almost worth as much as our house? Yeah, exactly. They go, well, does that make any sense? No! Can you live in it? Can you eat it? Can you drink it? No, it's completely useless as a mode of velocity, of current. You know, how can we get money moving around the world? You need to have some supply and you need to have some velocity. You can't do it with gold bars. You need to have a fiat currency. So we just have to reprogram and cut back some of the excesses and, you know, there's just no other currency. Europe, give me a break. Germany was the whole, you know, pulling the whole engine of the European economy. And guess what? It's not doing well. So, you know, it's just a function of who has the actual power to propel this thing forward again. And we have to get that person back in, you know, reasonable health. And as long as they have their rules in advance, as long as they know, I say the world is full of wonderful financial products and buy ideas. Your only hope is if you have your own rules in advance about what you want to buy, how much of it you want to buy, and at what price, and what you would do, like what your sell discipline is if you're going to have a sell discipline. If your idea is I want 10% or 20% or something of my net worth in gold, bullion, because it makes me feel better. It makes me feel that my risk is covered if there's a really, you know, horrendous scenario that I haven't thought of. But as John Nadler was saying, you know, if you hope that your 10% gold is going to double and triple, you're really hoping that your 90% of other assets are going down the drain. It makes no sense to peg your hope on that. So it's part of a diversified risk management strategy as long as you use it wisely.